to do part 2 of The Weakest Link. We're kind of excited. We went through phase 1. We looked at methods to evaluate distressed companies. And now, this part 2 here is identifying and reacting to these distressed companies before they fail. And we've gone from the methods to do this to actually doing some actual case studies. So I'm excited. And I want to thank the professional team that's been setting this up with me, Derek Viter, Andrew Bellman from Lowenstein Sandler, and Bruce Nathan, and Michael Papandrea. And you guys, thank you. I appreciate to work with you. This is great to put this together. I'm excited to move forward.
Yeah, thank you.
So what we're going to cover today, yes, I'm waiting for this next slide. And then we're going to cover a great case study. It'll be fun to hear this. This is the ascent of Ascend. It's a great way to look through this and see some of the things that we looked at last time and how to actually use them. Then we're going to talk about tools to mitigate loss before, but also during an event that's a default event. So let's step right into it.
All right, so it was promised that we would talk about a real-world example, and I love that this debtor's name is Ascend because it allows us to use a creative title slide, The Descent of Ascend. So we can move on to the next slide. And so what we're doing here is during the previous segment of this two-part series, Patrick, Andrew, the rest of us, we walked through, but primarily Patrick and Andrew, they walked through a lot of warning signs starting at a macro level, going down to a micro level that can be picked up on along the process of a potential, right now with hindsight 2020, a company heading towards distress, insolvency, and ultimately, at least as far as this little case study goes, an actual bankruptcy Chapter 11 filing. And those warning signs are obviously of value, right, to the extent you can point and figure them out. But that's the key. To the extent you can point and figure them out, to the extent you know that they have occurred. And towards the end of the last segment, Derek and I walked through some of the tools that are available both at your disposal. You might remember I punted a lot back to you, but also Cadex and Lowenstein's disposal that when we have, an entity on our radar, there's various points in time where we would get notifications through our various sources of potential events that might, be a clue into, hey, that's a warning sign that we just discussed on that webinar that we did with Cadex. And that if you're paying attention, you're being astute with respect to your borrower, you can be aware of in real time. And so what we did here is now, again, with hindsight 2020, we took a company that actually filed for Chapter 11, Ascend Performance Materials, large supplier in the auto parts space that ultimately, I'm going to give the spoiler and work backwards from it, ultimately filed for Chapter 11 in the middle of last year. And what we did was we said, okay, if we had our eye on this company, if we were really targeting this company, and also this is actually true that we did, but I'm going to just operate hypothetically. If we had our eye on this company, like at what points in time with the tools at our disposal, the tools at potentially your disposal, would these red flags and warning sign have popped up? And we're not going to dive into, Ascend like too specifically so as to bore you with the details. The point is more just to illustrate that over the course of that descent into what was ultimately a Chapter 11 filing, where were those warning signs? When did they pop up? And then as I turn it over to my co-speakers, they'll talk about potential tools at your disposal then actually deal with those warning signs as they arise in real time. So let's go back and just talk about Ascend. And again, like I said, the spoiler is that in mid-2025, this company filed for Chapter 11. And if you go back, right, and we pulled all the media and alerts and whatnot that cropped up over the year or so leading up to that filing. You go back to February of 2024, and S&P downgrades them to B based on continuing non-performance and a negative outlook. And you'll continue to see updates like that we get through these reporting agencies, S&P, Moody's, right? You continue on into March, a downgrade to B1, negative outlook. A little quiet for some time, but at least the downgrades on the radar. And then in September of 2024, you get another blip on the radar. Moody's downgrades again to B2 based on weak operating performance and a negative outlook. And you're starting to see the picture really come into the fold at this point. That again, if you're monitoring it, this is cluing you in, right, to potentially having to deal with this borrower, or be mindful or cognizant of this borrower. You flip the calendar over to January 2025. And this is where things really start to pick up speed. We're only now months away from a filing, but this is a huge clue. And I believe it was Andrew in the previous segment said, almost tongue-in-cheek, once certain professionals are getting engaged, that is perhaps the biggest clue, right? That there's going to be some sort of liquidity, insolvency event on the horizon, and in many situations, bankruptcy. And this is not to suggest that the firms you see here in the middle of this slide next to January 18, 2025, only deal in bankruptcy. They certainly do not. Full service firms, that operate all across the legal landscape. But for those who are familiar with restructuring at all, they would certainly know that if Kirkland & Ellis is being retained, and this reporting comes along with usually some sort of buzzwords around to pursue strategic alternatives, strategic options, almost anything other than to say, hey, we're going to file Chapter 11 soon. But if you see those buzzwords come in, they're a euphemism that might as well say that where this is probably headed. They're brought in for a reason. And it kind of continues from there. Evercore a week later is engaged by the lenders. Again, that's a firm that's often involved in the bankruptcy and insolvency space, and at the same time, reports around the first lien term loan being quoted at a fraction of what it was quoted at the very beginning of 2025, or not a fraction, but like 2/3, give or take, of what it was quoted at in 2025. And then this trend starts to continue for those who are paying attention to it. February 2018, now this is a year from the downgrade to B, but again, follows the overall flow of information. S&P downgrades to CCC+ based on an upcoming debt maturity and elevated leverage. Upcoming maturities, especially in a landscape that was talked about in the previous segment, where interest rates have significantly risen over when these facilities were maybe previously entered into. That's a warning sign for sure in and of itself. And you can move on to the next slide, and you can see the cascading events that then flow in with regularity. At this point, one would hope one's kind of been clued in for a period of time, but it kind of flows from there, where now the picture really comes into focus. Moody's downgrades in March based on financial challenges, and then you get the real signs. A Chapter 11 filing specifically is on the immediate horizon. Early March 7th, the debtors obtain a priming emergency term loan, and again now pricing far lower than what you had seen in previous reporting. And then over the following month, we're not putting them all here. Just trust us that in that bullet, March 7th to April 1st, 2025, Octus, it's a media outlet we talked about in the last segment, regularly sending updates regarding the fact that Ascend is exploring, you hear those buzzwords, right? Alternative options, restructuring options, et cetera. And then even the B word explicitly being used, bankruptcy. And then the real signs that a bankruptcy is coming up. April 1st, $100 million super senior secured term loan coming into focus. April 14th, now you're hearing explicitly DIP financing is being provided to the company, or is about to be provided to the company. Again, first lien term loan now being quoted at certainly now a fraction, roughly a quarter of what it was previously being quoted at. And then ultimately, the news that's being expected for those who are following along, April 21st, Ascend and its affiliates file for Chapter 11. At that point, Ascend went through what we would actually call in our space a traditional restructuring, which you don't typically or always see at this point. But Ascend filed. They didn't have a Chapter 11 plan, a reorganization at the time of the filing. They went through the traditional process of pursuing what options that were available to it. Ultimately, proposing a plan where certain lenders equitize their debt to take a portion, take the company over. And ultimately emerged from Chapter 11 in the late fall of 2025, and they've emerged now at this point. But the key isn't really to talk about what occurred in the Chapter 11. The key here is to focus on the fact that, for those who were clued in and paying attention, using tools at their disposal to catch those warning signs, those signs were out there and available. So then the question becomes, all right, Cool. We've caught the warning signs. Well, what do we do about that? I'm going to turn the mic over to my colleagues to hone in on that.
No, and before even finishing that, how fast you respond to the warning signs could be a function of how much you're going to be able to recover in the case. So we had 3 clients involved in the descent and ascend, one of which picked up the warning signs in the spring of the fall actually of 2024. And as a result of the time they had, they were owed several $1 million, and they were able to get out of the credit. We had another client that reached out to us in March of 2025, getting very close to the filing date of April 21. And they were able to recover about 75% of their claim, plus whatever they recovered on their unsecured claim in the Chapter 11 case. And finally, we had a client who reached out to us April 20th, the day before the filing, and we really were not able to mitigate their damages. We got them some as a result of they didn't make an advance, which they were planning to make as a result of the alert, and we were able to save them a little. But look at the difference in the recovery, and that's why these warning signs are so significant, and as said, it's such an interesting case. So let's go to the next slide, because once you figure out that there's a problem, what do? Well, first of all, even before the problem, the importance of reviewing your loan documents, reviewing your file is critical. But your loan documents can give you information that themselves could give rise to warning signs. Many loan agreements have extensive reporting requirements on the part of the borrower. Is the borrower in compliance with those requirements? For example, is the borrower required to give you quarterly financial statements and a yearly annual audited financial statements, but you haven't been getting any of that information, 1-2 years into the loan? Monthly financials internally generated, reporting with respect to the collateral. If your customer is not satisfying its reporting obligations, that is a red flag in itself. And this could be even before some of the red flags that Andrew talked about and that Mike discussed in the concept of ascend even came up. So you should be familiar with your reporting obligations. And the first question is your customer in compliance? Are they providing you all the reports you need to get? Because if they're not, a problem. And by the way, if they're not, and you wait, and you wait, and you wait, and then 2 years later you say you're in breach as a result of not satisfying the reporting obligations, I wish you luck, because the argument your customer is going to make is you failed to call a default or to notify us of this default. Frankly, you waived the default, and they could argue that you pretty much waived them not satisfying that requirement. So it's really important. We'll talk about how forbearance agreements fit into that. In addition, your loan documents may contain financial covenants and affirmative and negative covenants. And it's important in that situation that you're familiar with those covenants, and if your customer is in breach of any of those covenants, that you're aware of that, because again, that breach can be a warning sign in itself, and it's probably symptomatic of a lot of the warning signs that Andrew discussed last week. And these are things that you should be familiar with even before you become familiar with any of the outside external warning signs that were discussed. So let's talk. But once you get beyond that, when you see that there are warning signs out there of financial distress, once you discover that, the first thing you should be doing is reviewing your file. I like to call this period. I was in loan workouts for the first 10 years of my career, and when you find out that your customer is having financial issues, the first thing you need to do is to review your file and make sure that if there are any mistakes, they can be corrected. It is a lot easier. This is why, by the way, finding about the warning signs a year, 9 months in advance of a bankruptcy gives you a lot more time to do these fixes than if you discover the warning signs a day or two or a week or even a month before the bankruptcy filing. So that, again, it's really important for you to be on the lookout for the red flags, for the financial distress indications. And then once you find out You don't necessarily have the right to call a default, but what you should be doing is at least reviewing your loan documents to make sure that there are no mistakes, and if there are any, are they correctable? So, for example, you review your audit file. There could be a lot of emails in there that are troubling in terms of your relationship with your customer. Is there any way that a bankruptcy debtor or trustee can create a lender liability claim as a result of actions that you might have taken that could be deemed to be control of the company? You want to see those warts initially because that could affect how you react to a default and the actions that you would take. And also, by the way, the type of insolvency proceeding that you would prefer. You should be reviewing the financial statements, all the emails, and in particular, review your loan documents, amendments, and collateral documents. That's the security agreement and the UCC financing statement. And we'll talk about why that's so important when we get to the next slide. But I have one more, and then I want to turn this over to Patrick. You also should be reviewing your borrower's liquidity. And again, that's not necessarily contingent on finding out about a red flag. You should be looking at that again periodically. If you're getting borrowing-based reporting, which indicates the amount of liquidity your customer has, really, really critical. And if that borrowing base is getting dangerously low, even if you don't have red flags out there, again, that's a red flag in itself. And that's why your file contains red flags. And this review process is so critical. Shouldn't wait for the warning signs that we mentioned. Should be done before, but certainly should be done when you become first aware of the warning signs. You should also be checking into the status of trade credit for this customer, this financially distressed customer. Vendor support. Don't be surprised if the trade is discovering those same warning signs. They're getting a lot more sophisticated than they were 45 years ago when I first started practicing. And as they start restricting trade credit, that means the debtor has liquidity needs. And what are they going to do? They're going to draw on their availability on your loan facility, which may not be something you want them to do at this point because they're essentially replacing the trade credit they got with additional loans from you, secured loans as opposed to unsecured trade credit. And that is not a good thing. Patrick, what are some of the other tools that folks should be looking at?
You know, one of the ones I really love talking about here is audits and appraisals. It really gets down into the tangible day-to-day assets or collateral for some of these businesses. And a lot of these focus on receivables and inventory. When you start looking at receivables, and particularly ineligible receivables, ones that are no longer part of the borrowing base, it's a nice reflection of what happened in the company. You look at the receivables that are 90 days old, they tell you what happened at the company 90 days ago, right? So when we look at these, the question is, if receivables are aging out, why, right? What's the reason? It's nice to go in there and get some third-party overview, some valuations, and have some industry knowledge to find out what changed. Because a lot of times when a business has past due receivables, it's internal processes, it's internal problems. And it's great to expose those and find out up front, why are there problems? It really starts at the beginning. How is a company granting credit? Who's approving it? What's the methodology to grant credit on the front side of it? How are they billing? Did the billing change? Was there a billing problem, a pricing problem, delivery issues? So all of these things, and even Cash App, you got a buildup of Cash App that's not applied, you got an issue here, right? So all of these processes internally that lead to problematic receivables were self-inflicted. But you've got to look at a lot of these different things as well. When you look at eligibles, concentration risk is a big portion of ineligibles. Finding out there might be a big company that's got a big ineligible receivable, but are there other related companies, maybe under different names, different customer numbers, but they're all interrelated? You see that, and it helps you understand a little bit more about that ineligibility to make sure it's accurate. Oftentimes, we see increased disputes, and these disputes from these customers can be from a lot of things. Back to the same thing, billing issues, problematic product, problematic delivery. You get these disputes coming back, but then how is the company managing those disputes, right? So that's the ineligible receivables piece. But we also want to look at inventory. And part of these appraisals and these audits is understanding that inventory. What's the value? So a lot of times, and we'll talk about it in a minute here, but You look about the PMSI, purchase money security interest. Some of this collateral you think is yours, part of your collateral base, may not be, right? You might find additional UCCs that are in there, goods on consignment. And it's important to isolate those and find if they're there because that affects that collateral base. You run into some other things, landlords, other suppliers, and they kind of complicate the pure evaluation of this collateral. What's really mine? Shelving, inventory, what's part of it? The other piece I always think about with this is some seasonal inventory. A lot of these businesses, there's always a big season, and when that inventory is in there, it makes you think it's going to be in there for a while, but it's gone, and the value drops exponentially when the season is over, waiting for the next season. The last piece I'm going to touch on here is visiting these distressed companies, distressed borrowers, and we always talk about here at Cadex, walk the halls. You want to walk the halls and see what's there. And if you're trying to find out really the capacity of this company, if there's problems that are out there, we like to look in their faces because it shows. If there's financial distress, if there's anything going on in the company, you can see it when you walk the halls. Listen to questions and listen carefully to those questions. The other piece that's important for us is get out in the warehouse, right? When you're visiting any of these distressed companies, it's nice to get out there and see what's out there. How is it moving? How organized is it? What's in the back corner of the warehouse, right? Pallets stacked to the ceiling that are dusty, that have been there for a long period of time. I always think about the case where we visited a company that manufactured cowboy boots, and there was this massive thing in the back of the warehouse, dusty and old, and had them open the boxes, and it was pink, size 12 ladies' cowboy boots. Well, that product is worth nothing, but you've got to go there specifically to take a look, view it, and walk the halls.
You know, it's funny, Patrick, as you talk about walk the halls. I remember a situation I had 30 years ago where a client was advancing against accounts and inventory. They never visited. They got those wonderful inventory reporting. And when the debtor was on the verge of shutting down, they finally made their first visit. They were shocked to find that, to their shock, there was no inventory there. The inventory was all gone. And so the importance of a visit, both in terms of everything you said, walking the halls, reviewing records, but also just taking a look at your collateral to make sure it's there. Because I can't tell you how many times situations arise where the collateral just is not there or is a lot less than what was expected. Let's go to the next slide. So Patrick mentioned purchase money securities consignments. And before we talk about reviewing loan documents and UCCs and looking for mistakes, let's do a quick primer on how do you get your lender, you're making advances, and you want a security interest in essentially all your customers' assets. Well, your customer, in order to grant you a security interest, first has to sign a security agreement that identifies your collateral, and an identification of all assets is not sufficient. You need to identify the asset by category, accounts, inventory, machinery and equipment, general intangibles, other types of collateral and proceeds. But that's only going to get you as far as a security interest against your borrower. In order for that security interest to be good against the world, and the world could be a judgment creditor, another secured lender that files a security that gets a security interest in the same collateral as you, or a bankruptcy trustee. In order for you to be protected against those third-party interlopers, you need to perfect your security interest, and you perfect by filing, as a general rule, UCC financing statement that has to adequately describe the collateral, provide for the debtor, identify the debtor correctly. We'll talk about that, and be filed in the jurisdiction where the debtor is. We're talking about corporations, LLC, where the borrower is located, which is their state of incorporation or organization. If they're a general partnership, it's different. It's where their chief executive officers. If they're an individual, it gets a little bit funky. But that gets you, if you do it all right, get a perfected security interest that should be good against the world. The problem is too many times there are mistakes, especially in the UCC financing statements. By the way, Patrick mentioned a customer with a purchase money security interest. If you have that, if the customer has a purchase money security interest from its vendors, not only must that vendor file a UCC, many times a PMSI vendor will not do that and they will have no security interest. In addition to that, even if they file it, they also have to give notice to all lenders or creditors with a security interest in the same inventory in order to have a super priority status as to that inventory, which in all likelihood your loan documents would say is outside your borrowing base, because you certainly don't want to include that purchase money, purchase goods as part of it. Consignments have a similar rule. Similar requirement, UCC, financing statement, consignment agreement, and also notice to all the secured lenders. Any of those steps are missed, the vendor will not have priority in its consignment goods or its purchase money secured goods over above you, because the general rule for perfection and priority is the first to perfect wins. But there are a lot of ways for mistakes to be made. You might have entered into an agreement with your customer 20-something years ago and never bothered to review your customer's legal status and whether the name they were operating under when you first entered into your agreement is their current legal name. They could have changed it in a number of different ways, through mergers, acquisitions, spin-offs, reorganizations. Their name may have changed for a number of different reasons. You may have been dealing with a DBA doing business as, and maybe at one point that DBA was actually the correct legal name of the company, but it may have changed over time. So that becomes an issue, and that could destroy your security agreement as well as the UCC financing statement. What happens if the UCCs don't have a permanent shelf life? They are good for 5 years as a general rule, and you have to continue them within 6 months of the expiration. If you don't satisfy any of those requirements and the UCC then lapses, then you have nothing. What happens, again, if you filed in the wrong jurisdiction? The debtor had their chief executive offices in, let's say, Tennessee, but they were incorporated in Delaware. A filing in Tennessee would not work. You need a UCC filing in Delaware. Did you file in Delaware? If you didn't, again, that's a mistake that's correctable. Again, the correct legal name of the borrower. In order to have a perfected security interest, the debtor must be identified by its correct legal name. And that is something that does change over time. Best practice is for you to be monitoring that name periodically, because you can't be sure that the debtor will go through some case studies, Andrew and I, that show you how frequently name changes can come back to bite you. Is the collateral description correct? Or are you looking to get new collateral, which requires the amendment of UCC or the filing of a new UCC financing statement? If the name changed, the UCC requires that you file an amended UCC within 4 months of the name change. What happens if the name change was more than 4 months before? Does an amendment suffice? Do you need a new UCC filing? We'll discuss this in our case studies. But all of this stuff should be reviewed as part of your, I've seen these warning signs, now time for me to react. And the first thing you do is just make sure that your file is spiffy, clean, no problems. Because this time period, particularly if, like the dissent of Ascend, if you find out there's a problem and you got 6 or 7 months for the bankruptcy, you're going to be in a lot better position to be able to fix these things than if you're doing this a day, a 2 week, or whatever. So again, the time is now to start early and to make sure that you fix these issues. You also, during this time period, may find that your collateral position is not as good as you thought it was. Through that visit, you found out that the inventory was a lot less. So you saw through the reporting that the inventory and the receivables declined. And whereas you were fully secured, perhaps day one or maybe the first year into the loan, now you are undersecured. Do you have the leverage? If your customer needs you, especially if there's additional borrowing that's required, do you have the leverage to get additional collateral, whether it's from the customer on assets you previously did not have a security interest in, whether it's third-party assets, guarantees, side collateral from the third parties, which could be liquid investment type collateral, cash type collateral, or harder type collateral like a home? Do you need additional guarantors? If the principal owns property jointly you may need additional guarantees, and there are spousal guarantee limitations under the Equal Credit Opportunity Act that you need to take in mind. And there are other backstops like letters of credit. So this time period not only gives you the time to fix the problems, but if you identified that your collateral is perhaps your position is not as strong as you thought it was, getting additional collateral or backstops to protect you and increase the likelihood that you're going to fully recover on your claim. So let's go to the next slide. Why is all this important? Well, if you haven't noticed, we're going to tell you that time is of the essence. Again, if you're on that descent of ascend and you're reacting close to a bankruptcy filing, you're going to have a lot of trouble timely fixing the documentation errors, and you're going to have a lot more difficulty obtaining any new collateral to maximize your recovery. And here's why this becomes a problem. Let's say you had let's say your UCC lapsed, or let's say your UCC did not correctly identify the debtor's legal name, and you fix it. By the way, Article 9 allows you, if you have a good security interest in something and your UCC lapsed or had problems, you can amend, you can file a new UCC. You don't need a debtor execution of a UCC. The fact that the collateral is described in the security agreement is enough to protect you. But here's the problem. Let's say you fix all these problems and your customer files bankruptcy tomorrow or within a week or within even a month or two. You're subject to preference risk. And not to get into another topic in bankruptcy, but essentially a preference is any transfer to a creditor, to a creditor that's unsecured within 90 days of the bankruptcy to secure old debt, which would be your loan, while the debtor was insolvent, liabilities exceeding assets, which is presumed, which allows the creditor to get more than they get liquidation. Not hard to establish a preference claim where you are fixing a documentation error, whether it's in your security agreement, whether it's in your UCC filing, whether it's getting new collateral. If you do all this within 90 days of a bankruptcy filing, you are subject to that fixing being avoided as a preference and you being treated as an unsecured claim. And unless you extended credit afterwards where maybe there's a defense, you've got a real problem in being able to realize the benefits of the fix. Again, why? Time is of the essence. Why? Important if there's warning signs, you pick them up early, so you can fix and make sure that the fix happened well before bankruptcy and certainly outside the preference period. Also, if you wait too long to fix lien perfection issues, what happens if another secured party gets a security interest in your collateral and then files a UCC after you? I said the general rule for priority among secured lenders is the first to perfect wins. So you perfected first, you're good. But what happens if your UCC filing lapsed or became screwed up in some way? And now you are no longer perfected. And then you turn around and you fix the problem through this process we discussed. But if there's a secured lender out there who perfected their security interest after you, but before you fix the problem, you essentially go behind them because you became unperfected and your fix was too late. So that's why time is of the essence. The longer you wait, the more likely there'll be another secured lender who will end up going ahead of you. Also, there can be judgment creditors who execute on their judgments. And if they execute and get a perfected judgment lien before you fixed your UCC or your other problem, again, you will be behind that judgment creditor. So whether it's bankruptcy risk, whether it's the risk of another secured lender, whether it's the risk of a judgment creditor, the problem of you becoming unperfected and then trying to perfect, to avoid being an unsecured creditor, you could lose on that either because it was done within 90 days of bankruptcy, preference risk, or another secured lender comes in, or a judgment, another lien creditor comes in. So again, time is of the essence. Let me just talk about two quick case studies and then turn it over to Andrew, who has I think even a better one. I had one lender who was lending to a troubled borrower. The borrower merged with another entity and became a new legal entity. We did not know it. we got concerned about rumors of a bankruptcy. We actually alerted the client that this is another benefit where we were able to tell the client that this customer was having problems. And they said, okay, let's do a UCC search. We do a search and we find out that there were a lot of UCCs that were filed on a different name. And the client then discovered, kind of too late, I think, it wasn't too late, but it was late, that their borrower had merged with another entity and a new legal entity essentially took over. So what did we do? Could we file an amended UCC to reflect the name change? Well, it was a new legal entity. I'm not sure a name change would be okay. But we did an amendment, but we also did it, which, by the way, if the amendment was right, it would relate back to the original UCC filing. And here there was a real risk because the amendment was done more than 4 months after the name change, that would be enough. We also filed another UCC financing statement, essentially starting the clock again. We just held our breath for 90 days. The debtor didn't file their Chapter 11 until 120 days after we did this, so we were okay. We had another client who had done, who was a consignor, who did a consignment agreement with a company 25 years ago and never bothered to amend their consignment agreement to reflect the fact that this company had gone through many different legal changes, many different names. So their consignment agreement was off. Wrong. In addition, they never filed the UCC financing statement and they never complied with any of the requirements to get priority over their consigned goods. They called us. We said, okay. Within 2 days, we had signed an amended and restated consignment agreement with the correct legal name, and actually brought the document up to date from 25 years ago. We filed the UCC financing statement covering the consigned goods, and we gave notice to all of the lenders with a security interest in inventory. Thank God, the debtor didn't file until about 100 days after. By the time they filed, pretty much all of our existing consigned goods turned over, and what we delivered after we fixed everything then was able to withstand a bankruptcy filing, and we had no issues. We pretty much recovered 100% of our claim. But again, we saw warning signs, we identified them, and we did a file review, a lot of warts in the files, we fixed them, and then thank God the 90-day period passed and we were okay. Andrew, what about yours?
Yeah, so we had another situation that came to us last year involving a secured lender that had made a loan pretty deep into the 8 figures to an individual borrower. Now, that's obviously a little bit different from the commercial context, but some of the issues that arose are certainly analogous in the business context. So basically every error Bruce talked about on the last 2 slides that a secured party can make had been made here. You had a situation where a loan was incepted, a UCC1 was filed. UCC1s have a lifetime of 5 years unless they are timely renewed. Prior counsel, before we got involved, had allowed the UCC1 to lapse. They did figure that out about a month after the fact. They filed a new one. The problem is the borrower had packed up and moved from one state to another. As we all know, you file UCC1 in the state where the borrower is domiciled. An individual is not incorporated in a particular state, so it's not like the headquarters moves from New York to Delaware and suddenly, things change for an individual. Here, this individual moved, right? You have a window of time under the UCC. In this instance, they had 4 months to file in the proper jurisdiction where the individual had moved. They didn't. They refiled in the wrong jurisdiction, the old jurisdiction, interestingly listing the new address, but that's another issue. So at the time this happened, all sorts of bad things had happened to the borrower. The borrower was subject to a bunch of litigation seeking several $100 million in damages. And the lender was in a position where they had a lien on a whole bunch of assets in which they were currently unperfected. We got involved. We pulled a UCC search. We determined that, they had the perfection issue, filed a new UCC1, and, akin to the anecdotes Bruce told, had to sit there sort of holding our breath and waiting out the 90-day preference clock to make sure that refiling would not be avoidable. Thankfully, it wasn't. And at the end of the day, we actually ended up getting all our collateral back. So a good outcome. But certainly in the business context, keeping an eye on things like name changes, things like changes in state of domicile, which is an increasingly prevalent issue now. You see businesses re-domiciling from places like Delaware sometimes to places like Texas, potentially for strategic reasons, and Wyoming and other places. So things to keep an eye on.
And what's so interesting about your situation, Andrew, is again, it started out as an individual borrower, and it could be a sole proprietorship, Andrew Bellman Company, Bruce Nathan Company, and the rules for filings are totally different for those than they are for corporations and LLCs. Very, very interesting. And again, shows the value of identifying the red flags and then reacting to them quick. Time is of the essence. So let's talk about forbearance agreements, because we always tell the trade that whenever you hear the word forbearance agreements, that's not good news. It just means the customer is closer to a bankruptcy filing, because all the lender is doing is kicking the can for their reasons. And let's go to the next slide. What is a forbearance agreement? Well, if the borrower is in default, you don't necessarily want to call the default, accelerate your claim, and push them into bankruptcy, especially if all the warts that Andrew and I were talking about are there that you need to fix, and then hold your breath. You have a customer in default, and you've got problematic loan documents, and you haven't fixed them, and you call the default. You might find that your customer is forced into bankruptcy, and you're just an unsecured creditor. That is the worst possible situation, particularly if you could have used the time in advance that you found out about problems to be able to fix flaws and, again, improve your position. You do have that option. And if you see a default, and it could be as simple as a reporting requirement that's not satisfied, whether it's, again, reports, whether it's collateral information, whether it's covenants. And again, the key is if there's a default and you decide that you're not going to call a default, you just can't sit back and say, oh, okay, don't worry about it. I mean, it's fine. If you do that over a period of time, you may be deemed to have waived the obligation that you have in your documents to get reports, to provide for covenants, because you may have waived those rights by just deciding not to take any action. So in order to kind of have your cake and eat it, there's a default, but you don't want to take action currently for any number of different reasons. You should be entering into an agreement to forbear from calling a default, and then use the time for you to fix whatever you need. It avoids waiving the default. You are preserving all of your rights and remedies. This agreement can be as simple as an email, but you do need to preserve it. I had a client who was essentially not insisting on the reporting requirements, and we said to them, unless you send something out, even reserving your rights, saying you haven't complied, we reserve our rights to call default at a later date, unless you resolve this within 30 days. If in the absence of that, and we just sit back and do nothing, the borrower can argue, if we try to use that as that reporting default as default, they can argue that you waived your rights. The forbearance agreement is a really good device to preserve rights in that situation. It also gives you the time to fix your errors, get any new collateral you can negotiate, and to the extent we're dealing especially with collateral from your borrower, new collateral from your borrower, or any errors in documentation your borrower signed, hoping, praying that the 90-day period from the time of fix passes, and you're going to time your forbearance agreement to that time period, or you're going to do it perhaps with the intention of extending it or having another forbearance agreement. But the bottom line is you want to just make sure that as you consider the length of that time period, first of all, you don't want it to be too long, where the customer will be down the drain within 30 days. You can't do anything because you agreed to a 60-day forbearance, unless you provide for sufficient flexibility in that agreement to allow you to take action pretty much at any, at your discretion. Again, the length of that period could be tied to any new loans you're making, new collateral you may be getting. And again, to the extent you're fixing anything, try to minimize preference risk for either of them. By the way, forbearance agreements can be profitable because you can charge a very hefty fee as a consideration for entering into a forbearance agreement. It's not unusual for banks to do multiple forbearance agreements, going back to perhaps when you first identified the issue. You saw that the reporting requirements weren't satisfied. You might have entered into a forbearance agreement a year before the filing, and that may have been just for 30 days to fix it. It's not fixed. You enter into a second one. You maybe enter into multiple ones, and to the extent that you're able to earn a fee, just that much more money that's going into your pocket. Your loan document should have default interest, but if you're not calling it default, you're not able to charge it. But if your forbearance agreement allows you to charge it, that's perfectly fine. You may modify your covenants, perhaps to toughen them or to add any new covenants. Use that agreement to provide for the payment of legal fees, which and other professional fees for any professionals you need to engage, which hopefully are in your loan documents. But if there's any ambiguity, you fix it there. If you want to retain, have the debtor retain somebody that you're providing recommendations on as a chief restructuring officer or a financial advisor. You can require that retention be done by no later than a certain date, and the person has to be acceptable to you in your sole discretion. That can be in the agreement. There can be additional reporting requirements going forward. So again, good, nice, nifty device to protect you as you're identifying warning signs and then taking actions to fix documentation errors and also get more collateral. Finally, one last point. We've been talking about distressed borrowers. And now, especially in the supply chain, with all the issues that we have with tariffs, with the war in Iran, and other hotspots around the world, you may have a customer that is in okay financial condition, but they may have suppliers that are distressed for any number of different reasons. And if the supplier was to go down and liquidate, and they were the sole source of the debtor's supply of a particular product, and that product was necessary for your borrower to continue to do business, it would definitely be in your borrower's interest and potentially borrower's lender's interest to provide those suppliers in distress with financial accommodations to allow the borrower perhaps sufficient time to find another more reliable supplier. And in the meantime, having a source of supply in the interim and not having the risk that the supplier could just shut down and then the borrower is up the creek, and then that contributes to the borrower's financial problems, just a cascading effect. These types of accommodations include prepayments, and you may be asked as lenders to fund them. Your borrower may be a customer, and they have receivables owing to the distressed supplier, but your terms are, let's say, 60 days. But your supplier needs the liquidity now, so perhaps agreeing to early payment, perhaps temporary loans that would be repaid over time, or through either cash or in kind. The key to this is you don't want an arrangement which should be in writing to be permanent. That's why you need something in writing and not something that's just verbal, where it becomes questions to how long it lasts. It should be temporary, and it should be subject to termination pretty much at the discretion of the borrower and its lender, and it can be included in an accommodation agreement. Similar concept, but when you're thinking about your borrower, one of the things you also need to think about is, what about their suppliers? Any critical suppliers? Are they financially distressed? What's the impact of the tariffs and the war in Iran, the shutdown of the Straits of Hormuz, impacting the suppliers? Because that could be a weakness that nobody is identifying. Patrick, that does it for us.
Great information. I learn more every time I listen to this thing. So I love going through this. I'm going to take a minute and see if there are any questions out there. If anybody that's listening, there's a great opportunity to step in and utilize all this knowledge that's here. If anyone's got anything to say. Well, this works out good. I have a question. As many times we've gone through this, Bruce, you sparked something earlier today that made me think. You were talking about the PMSI. Now, I don't have my JD, and I know there's a few gentlemen on the phone that may have insight into this. But my recollection of this purchase money security interest is to get back product and proceeds. Now, I always think about product when I hear about this PMSI.
Wait a minute. key point.
Yes. Is it affect their receivables as
And
part of the
no,
collateral?
and I'm glad you raised the point, because if a vendor complies with all the requirements for purchase money security interest, they get a first and prior security interest in all goods they've supplied on credit. That would be ahead of any existing lender with a security interest in inventory. What about the receivables that arise from the sale of those goods? Lenders, the secured lender bar had a major influence over the old Article 9 and the revised Article 9. And all the versions of Article 9 have pretty much said that all the PMSI gets the vendor or lender that finances it a first priority in the purchase money goods that are sold, and any cash proceeds directly attributed to the sale of those goods. So they have to be sold on cash terms, or perhaps through some other vehicle. But accounts receivable that are generated from the sale of the purchase money goods, there's no priority. And that was intended to protect the asset-based lending bar, finance receivables, and they will always be ahead on receivables from all goods. Lenders will still want to keep that out of their borrowing base because their inventory would be of less value, but they will have a first on the receivable generated from the sale of those goods or from the sale of consignment goods.
I'm so going to ask, you filled in a huge missing piece for me, wondering about if that's on the books as a receivable. Is it part of that collateral base or no? So good. Right. So product and proceeds, good. I'll give one more minute. Anybody else have a question that came from this? That just means there was so much information in there. There's no questions. Nice job. I want to thank you guys. I really enjoyed working with Lowenstein and Sandler. You guys were great to work with on this, and I appreciate going through all this. We'll send out a link to this if anybody wants to watch this again in the future. But thank you, everyone, for coming and putting this together, and we're able to share some information that we think is really valuable, and hopefully you found it to be the same. Thanks.
In a world where the path from order to cash is fraught with complicated issues and interactions, someone had to make it easier to manage every process, payment, and exchange. Bringing together the most trusted names in AR management and collections, Cadex was built to clear your path to cash. We simplify the complexity of order to cash so you can move faster, perform better, and get paid sooner. Our solutions help you manage, recover, and retain revenue while elevating the customer experience along the way. Because in a global marketplace, better experiences drive better business outcomes. From order entry and invoicing to cash application and collections, we bring the right combination of people, process, and technology to reduce aging and accelerate your time to cash. And with over 2,000 clients served, we know past due isn't the problem, it's a symptom. That's why we start upstream with a customer-first mindset to prevent AR backlogs before they happen, because delays, disputes, and breakdowns don't happen overnight. They build over time through disconnected systems, stalled invoices, language gaps, and portal issues. You've seen them, so have we, and we've solved them at scale. We use your data to catch problems early, and we deploy intelligent workflows, automation, and self-service tools tailored to your business, so issues get fixed before they become fire drills. And after 100 years helping the world's largest enterprises recover receivables and collect what they're owed without compromising what they've built, we know just how challenging that can be. Which is why, under Cadex, we're helping enterprises transform how they manage order to cash with better reach, better guidance, and better tools. Cadex, built to get difficult done.